We are now standing in the final stage of a financial bubble, a phase that always feels exciting, safe, and full of opportunity. This is the moment when markets rise faster than ever, and people start believing nothing can stop the climb. But underneath all the excitement, small cracks begin to form. Prices drift far from reality, confidence becomes stronger than logic, and greed slowly replaces caution. The last stage is dangerous because everything looks perfect on the surface. It's the calm before the fall, the moment when people convince themselves that this time is different, even though it never is. If you're enjoying this breakdown, don't forget to subscribe, hit the like button, and check the link below for more content. Financial bubbles are dangerous because they feel completely normal while they are happening. They begin with something real and exciting that attracts early investors. As prices rise, people start to believe they are witnessing a new era of growth. Slowly, confidence turns into enthusiasm, and enthusiasm turns into blind faith. The bubble tricks people by making every warning sign look unimportant and every small decline seem like another chance to buy. Social media, news, and friends all repeat the same message: everything is fine. This constant optimism convinces people that risk no longer exists. They stop asking whether prices make sense and start focusing only on how fast they can profit. The bubble feeds on this belief, pulling more people in until the system becomes fragile. By the time most investors realize the truth, they're already overinvested, exposed, and unprepared for the moment when reality finally returns. Greed is one of the strongest forces in the financial world, and during the late stages of a bubble, it becomes almost impossible to resist. At first, people invest carefully, thinking about risk and long-term goals. But as prices climb faster, greed slowly takes control. Investors stop caring about value and start chasing quick gains. Every success story makes them want more. They see others making money and feel pressure to join in, even if they know it's dangerous. Greed also creates a false sense of confidence. People convince themselves they can't lose, that the market will keep rising, and that this time is unlike the past. They forget how quickly things can change. The market becomes a place where emotion outweighs logic, and even experienced investors get caught in the excitement. This is the moment when decisions become reckless, risks grow larger, and the bubble moves closer to its breaking point. During the final phase of a bubble, it seems like everyone has figured out the market. Friends, neighbors, students, and retirees suddenly feel like experts. People who never paid attention to finance are now giving advice, day trading, or showing off their gains on social media. This illusion of genius comes from the market itself. Prices keep rising, so it feels like skill rather than luck is at play. The problem is that this confidence is contagious. It draws more people into the market, and each new investor fuels the bubble further. The everyone is winning feeling hides the reality. Most people are simply riding a wave of momentum that will eventually crash. In this stage, logic and fundamentals are ignored, replaced by the belief that the trend will never end. This is exactly what makes the final stage so dangerous, because the last buyers are often the most convinced that they're smarter than everyone else. In the late stage of a bubble, stock prices often stop reflecting the true value of companies. Profits may be slowing, debt may be rising, and economic fundamentals may not justify the high valuations, but prices keep climbing. Investors stop asking whether a company is worth its price and start focusing only on short-term gains. This disconnect creates a dangerous illusion. The market looks unstoppable, but it's built on emotion and belief, not reality. People assume growth will continue indefinitely, ignoring warning signs. When prices rise far beyond what's sustainable, the market becomes fragile. Any small shock can trigger panic. This is the critical moment in a bubble. Everything seems perfect, yet underneath, the system is stretched thin, waiting for the inevitable correction that will bring reality back. Bubbles rarely announce themselves, but there are clear signs if you know what to look for. Corporate profits may slow while stock prices continue climbing. Debt levels, both personal and corporate, often reach record highs. Small dips in the market are quickly ignored as optimism pushes prices back up. Retail investors flood in, treating the market like a casino rather than a place to invest wisely. Analysts and experts keep finding reasons why prices can go higher, while warnings are dismissed as overcautious. Volatility starts to appear in unusual ways. Sometimes good news triggers drops, or bad news is shrugged off. These signs show that the market is no longer guided by logic or fundamentals. Instead, it is being driven purely by emotion, fear of missing out, and blind optimism, signaling that the bubble is nearing its breaking point. The blow-off top is the moment every bubble reaches its extreme, where prices rise almost vertically and logic disappears. It's the peak of euphoria, the point where greed is at its strongest, and everyone believes the market will never fall. At this stage, small corrections are ignored, and every new high attracts more investors desperate to catch the final wave. Ordinary people feel like geniuses, buying stocks with borrowed money and taking risks they would have avoided earlier. The market feeds on momentum alone, not on profits or fundamentals. Behind the scenes, however, the system is fragile. Debt is high, risk is widespread, and the last remaining buyers are fully exposed. The blow-off top is beautiful and profitable for a moment, but it is also the most dangerous phase because it precedes a rapid and often violent collapse that leaves most latecomers with huge losses. Every bubble has a hidden side that is invisible to most investors until it's too late. While the public sees rising prices, headlines, and soaring portfolios, the hidden risks quietly build. Corporate debt reaches record highs, consumers borrow more, and governments print money to keep the illusion alive. Margin debt, the money investors borrow to buy stocks, climbs to dangerous levels. Risk spreads through the system, even as confidence seems unshakable. These hidden pressures don't show up in the daily news, and most people ignore warnings. But when the market finally turns, these hidden problems amplify the crash. The more leveraged and overconfident the crowd becomes, the faster and harder the fall will be. This is why understanding what's beneath the surface is crucial, because the visible gains can vanish almost overnight. One of the most dangerous things about bubbles is that they disguise themselves as another rally. Everyone thinks they'll know when it's time to sell, but the top never announces itself. The market gives the illusion of safety, making dips look like buying opportunities and small corrections seem meaningless. Confidence is at its peak, and people convince themselves they are smarter than the crowd. Warnings are ignored, history is forgotten, and logic takes a back seat to emotion. By the time the first real signs of a crash appear, most investors are already overexposed. Panic spreads quickly, and selling accelerates the decline. The market doesn't fall because of a single event. It falls because belief collapses. Once the chain of faith breaks, prices drop rapidly, leaving the last buyers trapped and the smart money already gone. The final phase of a bubble feels like the peak of prosperity. Prices rise, everyone feels like a genius, and risk seems invisible. But debt is high, profits may slow, and the system is fragile. When the bubble bursts, the fall is fast and brutal, driven by panic. History repeats itself. Every bubble ends with fear and losses. Be prepared, not reckless, and don't forget to subscribe and like for more insights.